Real estate has probably been the best investment you've ever made, and I'm not here to argue with that. If you bought property in Canada sometime in the last 20, 30 years in Vancouver, Toronto, Calgary, anywhere with a pulse, you've probably done well. And some of our clients have done better in real estate than they did in their stock portfolio. So this video isn't about telling you that real estate is a mistake. It's about asking really a different question. One that many advisors are maybe too polite or too uncomfortable to ask and to bring up. What happens when the thing that built your wealth becomes the thing that traps it? Because for a lot of successful Canadian business owners or incorporated professionals or high-income professionals, that's where things are headed, right? Not because they've made any sort of bad decisions, but because they made a very good decision and then kept making it without building anything else around it. Hi, my name is Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial. And today I want to talk about something that really almost never comes up in financial planning conversations, even though it probably should. Real estate concentration risk. And more specifically, what does it mean for your retirement, for your liquidity, and for your ability to actually access the wealth that you've spent decades building? So this video might be slightly uncomfortable for some people, but this is definitely a conversation worth having. So how does this risk happen, and why does it make complete sense that it happened? So before I get into the risks, I really want to acknowledge something. The reason that so many successful Canadians have 60 or 70 or 80% of their money tied up in real estate is not because they were being reckless or stupid. It's because real estate in Canada has really been a good investment for like the last 50 years. If you bought a house in Vancouver in the early 2000s, it's probably worth 3 or 4 or 5 times what you paid. If you bought another rental property a few years later, same story, it's probably at least double or triple what you paid. If you bought a commercial space for your business instead of leasing, you've been building equity every year instead of writing a rent check to someone else. So now every single one of those decisions was rational. Every one of them probably made you money. And the problem isn't the decision, the problem is really what happens over time. And here's how that pattern kind of develops. So normally starts with your primary residence, the house you're living in, right? You buy the home, it appreciates, and then a significant portion of your net wealth is now tied to that one property. Fine, right? Most Canadians are in this kind of position. And then comes the next or first investment property. Maybe you bought a rental condo or a duplex, and then it cash flowed. Maybe even really well, and the value went up. So now you refinance that, you pull out the equity and you go buy another one. At some point in time, right, your business needs space. So instead of leasing or renting, you buy your building or your office, which is a smart decision commercially. But now real estate is in your corporate structure too. You've got your personal real estate and you've got your corporate real estate. And by the time you sit down with someone like me and we map out your full picture, your personal assets or your corporate assets, the business, there's real estate everywhere. And so I've sat across from people with like a 4 million or 6 million or 8 million net worth, where the liquid portion of their portfolio is maybe they could get $75,000 to $150,000 cash right now, right? So this gap between what you're worth on paper and what money you can actually have is one of the most important financial conversations that you need to have. And it almost never gets talked about when things are going well. And so here are some of the hidden risks that nobody really talks about. And here's where the conversation maybe gets uncomfortable, because when you talk to somebody who's got this high net worth, especially in real estate, the response is always something like, I know, but it's been performing so well. And that's true, it has, right? But past performance doesn't resolve the structural risk that comes with concentration. So we'll name some of these risks clearly because some people really haven't laid these out. So number one risk is it's not liquid. Real estate is not a liquid asset. And that sounds obvious, but the implications are maybe not so obvious. So if something happens and you need $200,000 right now in the next 30 days because you need to pay a tax bill and the CRA is going to call you, or maybe you have a business opportunity, or maybe there's a big family situation or a health event, you can't get that 200 grand out of the property quickly without significant cost, right? If you were going to sell, that takes time, usually months in most cases, if everything goes smoothly, and hopefully the price that you're going to get is what you want. So how does that work? You're selling the real estate. You need a buyer that's willing to pay the market value. You need the lawyers, you need agents, you need inspections, you need financing conditions to clear. You also need the market to be in a good place. You need the market to cooperate. And none of those things is guaranteed. And none of them are fast, right? You could refinance. It's faster, but this depends on a lot of things. It depends on your income. It depends on your debt ratios. It depends on the lender. Like, are they lending right now on that type of asset? None of these you fully control, right? So when people say that their wealth is in real estate, what they're saying is their wealth is stored inside a real estate asset that they cannot quickly convert to cash without some sort of cost, delay, or tax. So this is a huge liquidity risk. And you don't really notice that risk until you need the money right now. And maybe these risks are urgent. The second one is the market timing. You're really dependent. And this is one of the most uncomfortable realities of real estate. At some point, you're probably going to need to sell. So whether that's retirement, whether that's somebody passed away and you need to pay the estate, might be business succession, might be a health event that triggers this, but something usually forces the question, right? And when that moment comes, you'll be selling on the market's timeline, not on your timeline, right? The market decides how much you're going to get, not you. So we've seen people who planned to sell a rental portfolio to fund the retirement. And then they get surprised with a soft market like we're dealing with right now. Suddenly, they thought they were going to get $1.8 million for their condos, but they're really going to get $1.3 million for their condos because things have changed. So this isn't like a theoretical loss. That's a real change. That's 500 grand that you're not getting, and that will affect your retirement income. And so the fundamental problem is, you don't get to choose when you need the money. You only get to choose whether you've built alternatives for when the timing doesn't work, right? If real estate is your primary source of retirement money, you don't have alternatives. You're selling when you have to sell at whatever price the market is going to give you. So that's a timing risk that most people are carrying without really realizing or without putting it in words. So the third thing we want to talk about is your tenant and your cash flow dependency. So for people that have rental properties, there's this other layer of risk that's really underestimated when things are going well. And that's tenants. So right now, maybe your properties are fully occupied, rent's coming in reliably and everything's running fine. And that's great. But that cash flow is not guaranteed. Vacancies happen, problem tenants happen, rent arrears happen. In BC and Ontario, the landlord-tenant framework is really skewed toward the tenant, and Ontario and BC right now are having big problems for rental investors trying to either collect their rent or trying to rent out their place, especially the people that bought the pre-sales that are now sitting empty. So we've had clients that have had vacant properties for, 6 months, 8 months, 10 months during some sort of tenant issue. And during this time, you are paying the mortgage, you're paying the property taxes, you're paying the insurance, you're paying the legal fees, and you're getting zero rent. So for a high-income professional that you've got strong cash flow, it's painful, but you can manage it. But if you're in early retirement and you were counting on that rental income to fund your lifestyle, this could be more crisis than manageable. So this cash flow dependency on the tenant is a risk that doesn't show up in a net worth calculation. But it's a real risk, it's common, and it appears usually at the worst possible time, right? The fourth risk we'll talk about is your tax on exit. So this is one that generates the most uncomfortable silence in the client meeting. It's when you eventually sell an investment property or you transfer real estate as part of your estate, the capital gain tax could be significant. And in some cases, it's not just significant, it's like enormous. Right? So let's say you bought a rental property 20 years ago for 400 grand. Now it's worth 1.4 million. That's $1 million capital gain. Under the current rules, half of that is included in your personal income. So 500,000 is added to your taxable income in whatever year you sell. So at a marginal rate of 50%, you're looking at paying half of that in taxes. So $250,000 in tax on one transaction. And that's one property. That's if you've got multiple properties you're trying to do this with, or if the real estate's in your corporation, all of these numbers get bigger quicker. And most people have like kind of an awareness that there's going to be taxes when they sell, but not everyone's like actually modeled it out and written down. What does that look like in actual real dollars? And how does this affect the net proceeds that you're actually counting on for retirement or for legacy or for estate, right? So this gap between what your properties are worth and what you're going to actually walk away with in your pocket after tax is one of the most significant numbers in a financial plan, especially if the real estate is supposed to pay for your retirement. And it often doesn't get calculated until it's really too late to do anything about it. And, I'll just sell it later. That's not a strategy, right? So we'll spend a few minutes on this because it is an answer that we hear a lot when we raise these risks with clients. It's like, I know I have a lot of real estate. I'm very concentrated, but, I'll sell something when I need it. And totally understandable why this feels like a plan. The properties have gone up. The equity is real, in theory. So selling is always an option, but think it through, right? What does this mean? I'll just sell it later. It requires work. It requires that the market is strong enough that when you need to sell, somebody wants to buy it. And there's no guarantee of that. Canadian real estate is down right now, and nobody knows when it's going to recover, especially in Vancouver and Toronto. So this means that, if you want to sell quick enough to meet your needs, how do you do that, right? And as I mentioned earlier, a clean real estate transaction could take months. So if you need the money right now, your real estate might not help. It really, really requires that the after-tax, what you're expecting, matches what you actually get. And so most people haven't modeled out that tax consequence of what does it look like to have a full exit from your real estate portfolio. And when you do, the numbers are often different, and what you put in your pocket is actually often lower than what you thought you were going to get. And this is still happening, right? There are sellers here in Vancouver still now trying to get the old prices of real estate, but prices have come down and people aren't offering what they were offering a couple of years ago. So what are you going to get? So this also requires that your health and that your capacity allows you to manage this process. Selling properties or multiple properties is operationally complex. It requires energy, it requires decision making, it requires advisors, it requires time. And it's not something that you want to be managing if there was a health event or in the middle of an estate settlement or if somebody's lost capacity. And really, maybe more importantly, this requires that you have time on your side, right? If you're in your 40s, I'll sell later. You have decades of flexibility built into this. Market has time to recover if your conditions are not what you want right now. You have time to wait for the right buyer at the right price, as long as you don't need the money right now. But if you're in your 60s and you're retiring in a couple of years, well, this flexibility really, really shrinks. Your window of I'll sell later, you don't have a lot of later. The most expensive financial decision that you can make is not the result of a bad investment. It's the result of a good investment that you were holding in a structure that didn't really account for what happens when you need the money, right? So if you're in those age categories, I will sell later. It's not a plan, it's a hope. And hope isn't something that you want to be relying on for your retirement income, right? Most people want some sort of guarantee. And now, this is another big retirement danger. It's when you need money at the wrong time. And let me elaborate and paint a little picture here, because this is where the abstract risk becomes very quickly concrete and very personal. So let's imagine a client who's 62 years old. They've had a great career. They had a great successful business. Their primary residence is worth around 1.8 million. They have 2 rental properties worth a combined just over 2 million, 2.4. They've got a corporate investment account with about 600 grand in it. So total net worth on paper, 4.8 million. And they're planning on retiring at 65. And the plan is to sell the rental properties over the following next couple of years and use that money to fund the retirement and live comfortably on that income. Now, on paper, this is a great plan. But then, things happen in Canada. So the market is much softer now than 20 years ago when they bought those rental properties. It's nothing catastrophic. It's just a 15 to 20% correction, especially in the market that they live in. So now there's not a lot of buyers. Properties take longer to sell. The offers that come in are lower than what you thought you were going to get, right? So simultaneously, you've got a major repair happening in one of the buildings, right? The roof and HVAC system that the property inspector flagged years ago but wasn't handled now can't be deferred anymore. So now you need 80 grand out of pocket to fix this. Maybe one of the tenants stopped paying rent. So the process to address that could take months, right? Let's say in this case, they had a quick process. It only took 8 months. And then you've got your corporate investment account, which was supposed to be the stable secondary source of income, but the markets dropped. And it went down 18% in this period because the markets generally had a rough year. So now you're 65. You started this whole thing when you're 62. Now you're 65. Retirement's supposed to start. And the financial structure that looked rock solid a couple of years ago is now under pressure from 4 different directions at once, right? It's not a horror story because this person actually is still doing pretty well and you would be considered wealthy, and they're going to be okay. But the retirement that they imagined, where they exit cleanly and they convert their real estate into cash and they transition comfortably into the next phase of life, well, that retirement is now significantly more complicated. It's more stressful and it's more constrained than they had planned for. Like, they're probably not going to have the retirement income that they thought they were going to have. And the problem wasn't the real estate, right? The problem was that they didn't have any sort of financial structure that wasn't dependent on the real estate performing exactly as it should on paper and exactly to the right schedule of when you need the money. And that's the retirement danger. It's not losing everything. It's needing money now when your assets are not in a good position to provide the money. Now, what does a smart structure actually look like, right? We spent a lot of time in this video. We were talking about the problems. So let's spend a little bit of talking about what a solution actually could look like, because I want to be clear. The answer is not go sell all your real estate right now. I'm definitely not saying that. Real estate has built real wealth for a lot of Canadians for decades, and it will probably continue to. Then there's nothing wrong with real estate. I like real estate. I also own real estate. What I'm talking about is building a financial structure around it that doesn't leave you totally dependent on the real estate. And specifically, there's 3 things we want to talk about. So number 1 is liquidity layering. So liquidity layering is what it sounds like. It's building multiple sources of accessible money into your financial plan so that when you need the money, you're not forced to sell the one asset that takes 3 or 4 months to sell, and you have to be in a favorable market to convert it. And what does this look like in real life, right? It might be a well-funded corporate investment account that has a portion of it in liquid, accessible investments. It might look like a TFSA that's been maxed out and it's invested for growth. It might look like certain participating whole life policies that's been building cash values inside the corporations for a decade. And you could borrow against that cash value without having to sell anything, without triggering tax, and without depending on the market to be in a good position when you need the money. So the goal is simple, really. At any given time, if you need $200,000 or $500,000 or $1 million quickly, you have to have somewhere you can get it, which is not sell the rental property and hopefully it sells quickly, right? Liquidity layering isn't replacing the real estate. It's alongside the real estate, right? And what makes the real estate position sustainable over the long term instead of structurally fragile. Because when you have the liquidity, you don't need to touch the real estate and you can let it do its thing. The second thing is diversification without selling. And so this is a concept that a lot of real estate heavy investors really haven't encountered and a lot of times don't want to talk about, but it makes sense when you explain it properly. So most people assume that diversifying away from real estate means selling the properties. And if you've held them for a while, selling could be a huge capital gains tax bill. So the diversification conversation starts before. It'd be something that's like, I know I should diversify, but I can't afford the tax to do it. And that's totally normal. Diversification doesn't have to mean liquidation. So one approach to use is, use the equity that you've already built in the real estate. So you could refinance or leverage. You could get a HELOC. And then you could take that money and deploy it into other assets without triggering a disposition of the real estate. So you're not selling the property, you're borrowing against it and then putting that money into something else, right? So you're diversifying out of real estate. When you do this properly, you can start to shift your overall balance sheet without triggering the tax events that you would trigger if you sold. Another way to do this, and this is one that we use at Safe Pacific a lot, is to redirect some corporate retained earnings that we were going to be invested in more real estate, and instead we use a portion of it to fund a participating whole life policy inside that corporation. The policy builds cash value, which grows tax deferred. And so this creates that source of liquidity that's not tied to the real estate market, and it's not tied to the stock market. And it does all of this without requiring you to sell a property. So over time, say 5 years, 10 years, 15 years, this changes the composition of your overall wealth in a meaningful way. So the real estate is there, but now it's 60% of your net worth instead of being 80%. And that 20 is shifted to something that's accessible, liquid, and not dependent on market conditions. So this is, again, diversification without having to sell. The third thing is using insurance for your estate equalization or for tax funding. So this one comes up when we start walking through like what happens at death, right? The tax bill that comes at death is usually pretty high because the reality for a lot of Canadians, especially real estate heavy Canadians, is when you die, there's a deemed disposition, which means that the CRA treats all of your assets as if they were sold at fair market value on that day. So this includes your investment properties, this includes your corporate holdings, this includes any portfolios, this includes anything that's appreciated in value. Any sort of asset, the CRA is going to say, that's mine. So this deemed disposition rule means that the capital gains that have been accumulated inside your real estate portfolio for 10 years or 20 years or 30 years, they become payable all at once in the year of your death. So like this person we were talking about, if they got a $3 or $4 million real estate portfolio, that tax bill could be $500,000 or $800,000 or more. And this creates a real problem for the family, right? Because the tax is due regardless of whether or not you have the cash to pay it. So if the estate is rich in real estate and poor in cash, which is exactly the situation we're talking about right now, the family could be forced to sell the properties to fund the tax, right? And again, we talked about, is it the right time to sell? Is your real estate in a position to sell? Is your family qualified or competent or capable to sell this, right? And are they able to do it quickly, right? So your family has basically the same problem you did. Is it the good time to sell? And do they have the liquidity to pay this tax bill if they don't want to sell the properties? Maybe this property is really important. Maybe it's the ski chalet where you guys went for Christmas every year and you don't want them to sell it. You want them to continue to go for Christmas at the ski chalet every year. So they don't want to sell it, but they don't have the money to pay the tax. So they might be forced to sell it, right? And it might not be the best time, and it might not be the best price. And it's under pressure because something bad has just happened. You've just passed away, or somebody's just passed away. This is a bad time in the family. Is this a good time to make good financial decisions? Probably not. A lot of stress going on, right? There's solutions to this, and there's quite elegant solutions to this. Again, here, I'm going to talk about life insurance and having a properly structured policy, particularly like a permanent policy, a participating whole life policy that could be owned you personally or could be owned in a corporation, designed and calculated so that it can fund that tax on death, because that tax is payable right away. The CRA wants their money. And in Canada, the death benefit arrives pretty quickly. Most of the insurance companies that we work with will pay out a death benefit claim within like a couple of weeks of receiving the death certificate. If it's personal, it'll pay directly to the beneficiary, or if you're the beneficiary of your estate, it'll pay to the estate. If it's corporate, it'll pay to the corporation, and it'll create a capital dividend account, and then the money from that capital dividend account can flow through to your shareholder beneficiaries in a tax-free way. And it does exactly what it's supposed to do. It provides that liquid money that the estate needs to pay the obligations, to pay the tax, without forcing a rushed or discounted sale on that real estate. So your family can keep the properties, the CRA gets their money, nobody's forced to sell anything under pressure, and your family can still sell those properties if they want, but they can do it on their terms, on their timeline, without the rush of having to do everything right now. And this is kind of what estate equalization or tax funding through the insurance actually looks like. And if you've got a real estate heavy portfolio in Canada, this is one of the most important planning tools that's available. And here's the honest conversations that most advisors are not having. So I want to take a step back for a moment and be really like direct about this. The reason this conversation doesn't happen more isn't because advisors don't know about concentration risk, like it's part of the curriculum. Most advisors know about this. It's because the conversation is uncomfortable. Nobody wants to walk into a meeting with a successful client and say, hey, I think your biggest asset might be your biggest risk, and here's why, right? It's not a fun thing to talk about. And, when things are going well, it's hard to land that conversation. So when the properties are appreciating and the rent is getting paid and your net worth is going up, there's no urgency to address this structural fragility. And also that problem doesn't feel real because it hasn't become real yet. But here's what we've learned about, after doing this for decades. The clients who are most glad that we had this conversation are never the ones who had it when the problems were showing up. They're the ones who had the conversation 5 or 10 years before anything went wrong, when there was still time to build the liquidity, when there was still time to do the diversification on your terms, time to put the insurance structure into place, time to do the corporate structure into place. Actually address these structural dependencies before retirement is 6 months away and now I need to do everything right now. By the time the timing risk is real, by the time the market is soft, by the time your retirement date is too close, by the time the tax bill is looming, all of your options get more and more and more limited, and the solutions become more and more expensive. So the best time to have these conversations is before you need to have the conversation. That's when you have the most flexibility. That's when you have the most options. That's when you have the least cost to address what needs addressing because you can do it on your time and there's no rush. Let's bring all of this together, right? Real estate is a good idea generally. It's built a lot of wealth for a lot of Canadians. That's not up for debate. The wealth that's built on this concentration, even though it's excellent and it performs well, it has risks that don't show up when things are going well. That non-liquidity, your market dependency, especially for timing, the risk on the tenant, the taxes, and this growing gap between what you're worth and what money you can actually have. And then as you get closer to retirement, these risks become less and less abstract and they become more and more real. These become the actual constraints that determine what does your financial retirement look like? What does your estate look like? What does your family inherit? And under what conditions? Is it a smooth transition or is it a huge pain and everyone's mad at each other? The good news is none of this requires massively dismantling what you've built. Adding liquidity, adding diversification without selling, adding insurance for the estate tax funding or for the liquidity. These are all things that work alongside the real estate. They don't work against it. They're designed to take this concentrated, successful financial position, but build a structure around it that makes it genuinely resilient over the long term, and it gives you flexibility and optionality. So if you're a business owner, you're an incorporated professional, you're just generally a high-income Canadian, and you've been listening to the video thinking, hey, this could be my situation, take it seriously. And I'm not saying anything is broken, but really the best time to strengthen the structure is before you need to do that, before something is testing the structure. Now, if you want to sit down and actually walk through what do these numbers look like, what does your real estate exposure look like? What does your liquidity look like? What does your tax liability look like on exit or retirement or on death? Well, this is what we do, right? Next steps is just set up a discovery consultation with us. This is what it's designed for. We will look at your full picture. We run the real numbers. We'll give you a straight up and honest assessment of where these risks are and what addressing these risks looks like and what not addressing these risks looks like. There's no pressure. There's no rush. There's no agenda other than just making sure that your financial structure is as strong as you need it to be. And you can book a time with us really easy on our website. It's safepacific.com. There's booking buttons all around the site that'll link you directly to our calendar where you can find a time that's convenient for you. Or you could just send us a message through the website, through the contact page. Those will come to me. Someone on the team is going to reply to you within 24 hours to set up a time to meet. Maybe we'll ask some more questions and get some clarification. And then, stick around. Keep watching all the videos. We have hundreds of videos here on YouTube that'll help to talk about all of these things. Now, before you go, quick favor. Can you please make this video more successful? And can you get it out to more successful Canadians like you? And the way you do it is super easy. You click all the buttons that the robots and the algorithm likes. That means click on like, make sure you subscribe, share this with somebody. And if you have any questions, leave them in the comments below. If you just want to yell at me and cause rage engagement, I love that in the comments below because that really helps the social media algorithms go crazy. These are really specific problems that we're talking about today, and this is not everybody that's in this position. So finding the people that have, multiple real estate holdings in their portfolio, sharing this through the algorithm is how we're going to find them. And I really appreciate any help that you can give on that. So my name is Laurent Munier from Safe Pacific Financial. Thanks so much for watching, and I will see you in the next video.